We're going to talk about the bond market here. I want to talk about how it relates to the stock market, what you're seeing in the rates right now, because it's getting really crazy, I guess is probably the best way to put it. It definitely has me on edge. I'm a little bit nervous about what we're seeing with the rise in the rates, even though the Federal Reserve is believed by a lot of people that they're done raising rates for now. The rates are still going higher. So you've got, especially even this week, you have the 10-year yield, which is what heavily influences the 30-year mortgages that so many of us have. That thing continues to skyrocket. That's going to kill the housing market. In fact, it already is killing the housing market. And how does it translate to stocks? Because right now, we're not really seeing a huge sell-off in the overall market. Yeah, we saw a sell-off in August and in September, but we haven't really seen it here in October. We're actually like stabilizing quite a bit. We've seen a good pop off of the lows of late. We essentially over the past, I would say about the past month, the market has stabilized. And it's not that far. The Qs aren't that far off. Neither is the SPY off from their all-time high. Why is that? Because you have such a concentration of money in your FANG stocks. That's Meta, that's Apple, Amazon, Netflix, Google, Microsoft, Nvidia, and Tesla, that it's buoying the rest of the market. If you want a true glimpse of what the market looks like, look at the Russell 2000. It's an absolute disaster. And then if you look at some of these sectors, you only have like 4 or 5 sectors out of 11 actually trading higher this year. The large majority of profits are limited to communications, which has Google and Meta and Netflix in it, technology, which has Microsoft, Apple, Nvidia, and then discretionary, which is Tesla and Amazon. Those 3 sectors as a whole are up massively, like 30, 40, 50%. And they're the very reason why the market hasn't fallen apart this year. But if you look at the Russell 2000, which doesn't have those big tech stocks, it's just small caps, you get a much clearer picture of the overall economy. But first, make sure that you like and subscribe to this live stream, because guys, it helps me to continue to do these week in and week out. If you guys aren't doing it, it's not helping me none at all. But so I really do appreciate it. Let's go ahead and get into it right out of the gate here with the Qs. So on Qs, this is what I wanted us to look at first. Qs, you have the support level right here. Then you have this resistance level going all the way across here. So price is contained inside of it. Now you have this bull flag pattern, these 2 yellow lines. Is that big of a deal? No. The reason why I don't really put a lot of faith in this bull flag pattern here that I've drawn is because if it breaks out of it, what does it do? It goes right into this resistance. And the last 4 times, 1, 2, 3, and 4, the last 4 times it's tested it, it's rejected price. So why would I get long on a breakout of this bull flag only for it to hit this resistance thereafter? The Qs are holding up pretty good. I mean, this is where the July highs are. The July highs are like, what, 387? So it's not that far off. You're talking about, $19, $20 on the Qs, a little more than 5%. That is very attainable. But then when you're looking at like what you're seeing in the Russell 2000, where it's struggling mightily, and then you're seeing where the 10-year yields keep going higher, which keeps putting pressure on all of these big tech companies to raise capital. It's a huge problem, and it's not being reflected in the Qs. You look at the weekly chart of the Qs, you zoom out far enough, what does that look like to you? It looks like a bull flag. And so you're not getting the breakdown that you're seeing necessarily like in, say, IWM, where on the weekly chart, it's trading at the lows back from the March regional banking crisis. And then again, the lows from April. It hasn't been able to get off the ground. Yeah, it's got a little bit of a dead cat bounce going for it, but that's only like the second positive week so far, and there's still 3 days left of the week, obviously, since August. So this could easily be a dead cat bounce in IWM, but in the Qs, it's a totally different picture. It looks like a freaking bull flag. So, in any case, going back to the daily, what we're looking for here is, does this rejection hold? If it does get back up to this level, does that rejection hold again at 373, and does it push price back down? If it does, then this 353 level becomes the next level of importance for the Qs. And if that can't hold, that's where things start to get kind of hairy, because then you got this, there's really no support until you get down to this 328 level. That's where I would like to ultimately see this thing get down to at least and test. And the reason for that is because the 10-year, this is a huge problem for the market right now. The 10-year yield, this is TNX. You can get it on most of your platforms. It's the 10-year Treasury Index. And right now it's at 48.5. And where does that put us at over the last 20 years? It puts us in a pretty bad spot. It puts us right here at this resistance here. Let me even put it up on a monthly so it's a little clearer. Right here, you got resistance that goes back to 02, you got another test in 07, and then you have it again testing here in 2023. Well, it's interesting. What happened right here, but right when we tested this one? Yeah, it came down thereafter, but you also got into the Great Recession. This almost marked the start of the Great Recession. Here we are again, testing this huge resistance level. So this is a big problem for the market overall. And by and large, it's been skyrocketing over the last 6 weeks. Market doesn't care. Market doesn't care at all. Again, let's look at the Qs, see exactly what I'm talking about here. On the Qs, over the last 6 weeks, we've actually traded higher. Does not care. And you have stocks like Nvidia where it has a 105 PE ratio. It comes out with news today. Yeah, it was down 4.7%, but it actually spent most of the day rallying off of the lows after Biden said that they're not going to allow for AI semiconductors to be shipped to China. Wall Street could have cared less. Went down and tested this rising trend line right here off of the February lows and bounced off of it. But you still have a huge head and shoulders pattern forming. So there could be the development here of a major topping pattern in Nvidia that nobody's really talking about. You look at something like XLU, which has had a horrible time over the past month. And look at this. This was a topping pattern that nobody was talking about until it finally did confirm to the downside. So just because nobody's talking about it, usually those are the ones that tend to confirm the best. And that's a massive head and shoulders pattern. The VIX. What's been very odd about the VIX? I mean, look where the VIX was at. 2021, 2020, 2022. It was elevated, right? Compared to where we're at right now. Now we broke below this the support level, acting now as resistance. You got a little bit of a double bottom. It can't get out of it. It can't push through it. So we've had a couple of days where it tries to push through it, and then the next day it is just an absolute sell-off in it because the sellers step in, the volatility crush takes place. So it needs to get back above this 19 level, preferably around 20, then get back above that 21 level. But right now, there's no fear in this market. There's zero fear. People are still buying the dips. A lot of that comes back to the zero DT call buyers. I mean, especially today, you had a number of events that should have brought the market down lower. You had retail sales completely blow through expectations. Retail sales was came in at 0.6 and they were expecting 0.2. Guys, that's a huge beat, and that is not what the market needed. And yet you still saw the market just completely rip higher.